Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
All right, back here on the Investor Coaching Show, Paul Winkler talking about money and investing, and a little bit of economics here once in a while, and some of the stuff of the news of the day, and some of the things that are being talked about out in the financial world. The question was raised by the Wall Street Journal this week: was do we make economics a college requirement? Now, we had a little conversation about this in the office, and it was talked about that it is in some high schools, I guess, being taught economics. I don't know how much in depth it's being taught, but they were talking about actually pulling it out of high schools. They were literally talking about pulling it out of high schools and replacing the economics teaching. This was in a separate article someplace else. It was being replaced on just personal finance. And my thing is like, gosh, the research on teaching personal finance in high school isn't so great, and it's because you're not utilizing it right away is the problem you run into. A lot of the kids will be learning about concepts that they're not going to use for a decade, until they get finished with school or until they really get their real first job and they start to get into the work world. So teaching them that early, the studies that have been done on this show that the retention is terrible. They just don't retain the information. And the question here is, and they were talking about there is, do we replace teaching economics and will they retain economics? I don't know, but I think just the general concepts of economics are super, super important, supply and demand, but also how economic systems work. And that's really what they're talking about here. As a college requirement, do we do this? And the point here, they're saying that this guy's talking about, he teaches in, I guess in one of the universities. He said he's seen a striking shift amongst his students. And he says they arrive at campus not only skeptical of free markets, and this is an important point for me because we've talked about free markets all the time on this show. The idea is that you get to participate in capitalism when you're an investor. You get to own companies. I'll often ask kids, who are the most successful people in the world? And they'll often say, Elon Musk or Bill Gates, or they'll name people that are and they'll have a whole list, and I'll say, what do they all have in common? They'll say, well, they're all business owners. Yeah, and you get to be a business owner too when you invest in the stock market. You just don't have to work for the company, but you may own tens of thousands of companies. So that's the beauty of it, is you actually have this ability to own lots of different companies all around the world. And, and here, and when we're looking at economics and we say, okay, so how does this relate? Well, with economics, we have to have free markets in order for economies to work. Supply and demand, we have to have the ability to trade. I always marvel at the idea that you can have a police officer that doesn't know me from Adam, or a military, and none of those people know me from Adam, that will protect my rights to own property, which is pretty cool when you think about it. It is the beauty of, and you look around the world and capitalism has been growing, not shrinking around the world. There's a really interesting study I've referred to many times where this guy takes life expectancies on one axis and he looks at incomes on another axis. And what he shows that throughout time, he actually applies this graph in motion, showing how over time countries have grown life expectancies, they've increased them, and grown incomes. And it's all around the world. And you see this move from left to right on a diagonal pattern, and you go, wow, what is responsible for that growth in life expectancy and incomes and financial prosperity? And he basically points out that it has been the expansion of capitalism all around the world. And you go, well, what is capitalism? What's our ability to own property? The invisible hand, the idea that Adam Smith proposed was that if you let markets do their thing, what will happen, prices will get set properly. If somebody's offering a good that isn't any good, nobody's going to buy it. they're going to gravitate to the person that makes a better widget. They're going to gravitate to the person or entity that provides a better service. And what will happen is people will vote with their pocketbooks. And if I am going to be successful, I have to be others-centered. I have to be thinking about your problem and solving your problem better than my competitor does. And that is a basic tenet of capitalism. Now, in this article, he talks about rent control. There are certain things that we feel like we've got to control, pricing controls. And a lot of times kids don't remember or weren't exposed to the idea that back in the 1970s, this was tried, price controls, rent controls. And it failed just abysmal. It was awful, the results, when these types of things were attempted. And now we're thinking about, hey, let's do the same thing. Let's put government in charge of more things. And what we know is that government's terribly inefficient. It was believed at one point in time that the Russian economy was going to overtake the U.S. economy because they were more productive. And then when we really looked into it, we found that they were producing garbage. And yet they may have been producing more stuff, but it was more really bad stuff. And the reason is because you had a centralized entity making those decisions. Now, he says here that up to 3/4 of college, and then he asks this question. He talks about rent control. He says, housing's a human right. Markets have failed, but when I ask simple follow-up questions, such as how housing actually gets built if returns are capped, he says the class goes silent. And that's the problem with this type of thinking, economic socialism, or democratic socialism. It is the idea that somehow we can have this utopia by putting people that are really smart in charge in a centralized committee, and we could grow the economy at a faster pace and we can make better stuff. Well, this is something, and the reason I said this has a parallel to stock markets is I remember one of the academics I studied under making the parallel between Cuba, North Korea, and he talked about active managers. And he says, of course, North Korea and Cuba, both communist countries. And he says the idea is you could put a bunch of smart people in a room and they could grow the economy at a faster pace, and that didn't happen. Well, it's the same thing when it comes to investing. We can have these professional managers and these investment committees that come together and try to decide which companies are better than others, and we can grow your investment portfolio at a faster pace. And they would make the comment that, it doesn't work there either. And I think, should we have people taught more basic economics? I think it's an important thing, because if you don't understand history, you're doomed to repeat it. And so often people don't understand the history when it comes down to it. When I talk about active management, let me just talk about that just for a quick second, because, case in point, what were a lot of people doing at the beginning of the Iran conflict? All of a sudden, what did stock markets do when that broke out? They dropped, right? And people wringing their hands. Oh my goodness, it's scary. The stock markets have dropped. Well, I thought it was funny on CNBC this week. David Faber and Jim Cramer on there talking with each other. And here is what David had to say regarding the Iranian conflict. Check this out.
No, but wasn't a lot of this, I hate to use the word, but it gets used so much, positioning? I mean, the fact that we had a conflict going on with Iran that seemingly was headed to an even more hostile place, if that's possible. And that's no longer the case.
So what happened? People thought things were going to be really, really bad. It turned out not to be the case. It wasn't as bad as people feared. So stock markets went down in anticipation that things were going to be really bad. What did people do? A lot of people sold. Now, of course, people say that, there's a sell-off on Wall Street. And I often make the point, no, there's a buy-up too. Because if somebody's selling, there's somebody on the other side of the trade they've got to be buying. And that's exactly what happened. You had a lot of people that said, hey, you know what? I got a stomach for risk. I'll buy. If you're selling at a lower price, I'll buy. And that's exactly what happened.
Had a lot of investors who'd taken risk off again, and one of those, and here we are.
And they took risk off. You notice he said that word, you had a lot of investors that took risk off. What did they actually do? By taking risk off, they put risk on. Because basically they sold at low prices, which is what? It's a loss. That doesn't make any sense, does it? You think I'm taking less risk, and what do? You go invest in something, and then the thing that you sold ends up going up in value. And it's just, people shoot themselves in the foot.
And everybody suddenly said, whoa, we're not positioned properly, and I got to buy a lot of these names. And
so there you go. We're not positioned properly. Oh my goodness, I got to buy. So you sold low, and what did you do? You bought high. Is that risk off? I have a problem with that terminology, that's a risk-off behavior.
they re-enter many of the same trades that were on prior to at least the beginning of hostilities.
I should have started with that. That's a great way to look at it.
I think it's funny. Jay Kramer's like, yeah, I should have started with that. That really makes sense, because you're making some sense here, David.
And I've got my monthly call today, and I've got to adjust it because I did not take into account that the reason why we have this tableau. There you go. You see those winners? The reason why we have this tableau is it's allowed to happen. It's allowed to happen because of the narrative that the president is saying.
So, in effect, we got caught. The tide goes out. We see who's swimming out without a suit, right? And all of a sudden, people end up in a situation where they lose and they've got to cover it. And the professionals, the best known people out there, the people that are best known are caught. Oh my goodness, I need to adjust. I never even thought about that. Yeah, you're probably right. Hey, just a note to you podcast folks, we just came out with a retirement income guide, and I'm super excited about this. There are all kinds of myths about taking income in retirement. People worry about running out of money, and rightfully so, because a lot of these myths can actually cause that. Now, the myths that you typically hear about, number one, like dividends, living off dividends in retirement, real estate, life insurance as a retirement investment, and annuities, and interest-bearing accounts, and target date funds. There are all kinds of things out there. What I want to do is put something together that walks through why those things are problematic, number one. Number two, the other thing that I wanted to do is walk through the evidence-based research on taking income in retirement. And we got a ton of data going all the way back to 1900. What's the logic behind it? And it's intensely logical. So we put that together, and all you have to do to download that, making it super simple, just go to paulwinkler.com/relax, and you can actually get into that very easily right there. So I would urge you to do that. Check it out, because I think you're going to really like it. paulwinkler.com/relax. Okay, so one of the things that I have been talking about this week with people is this idea of attention. Okay, so I don't know if you've ever seen the video out there. If you've never seen the video, I'm going to ruin it for you. Here it goes. There is a video out there that shows how, as humans, I talked about how emotions drive so much of the bus. Well, it's our attention. We are finite beings as humans. We can't concentrate on too many things at once. Now, when we look at, I'll give you an example. There's a video. They have these people, just a group of people in a room, and they have a basketball. And they're bouncing the basketball, and they're passing it between each other. You may have seen this before. And the person narrating says, count the number of times that the players pass the basketball with each other. And they have multiple basketballs, as I recall. And they're passing it, and you're counting how many times they pass it between each other. And at the very end of the video, it says, did you get the number of times that they passed the ball? And then you say, well, 16 or whatever. You say whatever number it was that you counted. And then they'll go, did you see the gorilla pass between them? And most people are like, what? Because you're concentrating on counting the number of times that they passed the basketball, and you completely miss the fact that a gorilla walked in the middle of the group. Walked in, waves at you, and walks out the other side. And then, people catch on to this idea that there's a gorilla, and the next time they do the video, they say, you may have seen the gorilla this time. Did you notice that the background color changed? And, people don't notice the back. And then another time they do it, did you notice that one of the players left the game? And that's just the idea. It is, so difficult to keep our attention on a lot of different things. And you go, well, when we invest in individual companies, how do these commentators on TV decide which companies to actually spend their time talking about? And I've made the point so many times on this show that the companies choose you. You don't really choose the companies. And what makes them choose these particular companies to talk about? And I'm going to tell you, it is the performance, recent performance. If a stock goes up in value a lot, all of a sudden now they've got to talk about it. This particular stock went up, and then they start talking about all the glowing things happening at the company, which causes you to want to do what? Buy that stock. Because you're hearing all the glowing stuff about this company, how great it is, and I want in. And what we don't recognize is that the reason that stock went up was that glowing information came out, and the price went up because people that own the stock right now, or before the information came out, they're not going to sell it to you for a song and a dance. They're going to demand a higher price for that stock. And then you buy it at that higher price based on this information, thinking that it's going to continue to go up because we pattern complete.
Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.